So today we are going to talk about option pricing theory. This time we are going to numerically evaluate the pricing of calls and puts using the concept of hedge portfolio and the binomial option pricing model. And if you look at the article and if you have already read them, you will find that there is algebra involved, and in some cases, I've tried to avoid uploading teaching notes that involve matrices, but you would see that there is numerical content and there is evaluation of the formula, or you can say the how the binomial option pricing formula is derived, and then the option Greeks. They are quantitative. If you can understand it, well and good. It's recommended, it's suggested. But if you can't, you don't need to. Even whatever we have in the book and on the slide is sufficient for you to understand the pricing of puts and calls. However, if you just put an extra effort and try to learn the mathematics, that will help you further, particularly if you plan to do anything related to financial engineering and new product development in finance. If you are interested, I highly recommend that you should just give it a read. But you will see that even the slides are a bit quantitative in nature, and at times I'll be showing some derivations of formulas. So we will learn about the concept of option pricing model and the 1 period and 2 period binomial option pricing models, explanation of the establishment of maintenance of a risk-free hedge. That has been the main thing. We have been talking about it from week 1. So we will learn how to use a hedge portfolio and how to use it to explain that our price of the call or price of the put is arbitrage free, and that is, it is a fair price. And then we will learn about early exercise of a call option or a put option and how this can be incorporated in the in the binomial option pricing model. After learning about the 1 period and 2 period and 3 period binomial option pricing model, we will learn about extending the binomial model to any number of time periods, and particularly we will learn about how it will work when we have n approaching infinity. And then there are different alternative specifications of the binomial model. Of course, the one will be the one that is the limit of the black option pricing model. First, we have to understand what a model is. Now, in qualitative sciences, basically, we use the word theory. In mathematics and econometrics or statistics, we use the word model. A model is what, or a theory is what? A simplified representation of reality that uses certain inputs to produce an output or results. For example, in capital structure theory, you learn how the different levels of debt will affect the value of the firm and the cost of capital and the cost of equity, and how you can use that understanding to determine which is the appropriate debt and equity level for the business. Similarly, there are different theories of dividend, like the bird in hand theory, the tax loss hypothesis theory, that help you understand how much dividend you should be paying. In fact, whether you should be paying any dividend or not, if yes, how much. Similarly, when you talk about stock valuation, so you have the Gordon model where you discount the future value of dividends to get the price of the stock. So what are you doing? When you value the share of a company using the dividend discount model, you are trying to present a simplified picture or analysis of the valuation of a company by saying that the price or value of the stock of a company is equal to the present value of all its future cash flows. So a model or a theory, in simple words, is a simplified representation of a reality that uses certain inputs to produce an output. So you are interested in knowing what causes what. So there is a cause and effect relationship in a theory or in a model. What is an option pricing model? So again, it's a mathematical formula that uses factors that determine an option's price as input to produce the theoretical fair value of an option. So we will learn about the different inputs, for example, the stock price, the exercise price, the risk-free rate, and the time to expiration, for example, and dividends as well, that determine the price of an option. and we will learn how to combine them in a mathematical expression to determine the theoretical fair value of an option. So for us, the option pricing theory or the option pricing model, as in the case of binomial option pricing model in the first sense, we will see that the input we use in this model will be the same when we go to another theory, which is the Black-Scholes option pricing model. So when we say the option pricing model, there are broadly two models. One we are discussing today, the binomial option pricing model, and then there is another one which is the Black-Scholes option pricing model. And as we move to discuss that later in week 5 and 6, you will see that both these are the theories to value an option. However, there are differences. So the economic the explanation provided by one theory of the reality is different by as presented by another. So for example, we have the theory, which is the Miller and Modigliani theory of capital structure, that says that the company should actually go for more and more debt. But then we have another theory, which is the signaling theory. Again, it is using nearly this similar inputs, but it is telling us otherwise, and it's saying that the amount of borrowing or the company issuing a bond or the company issuing a stock signals information to the market, and which is perceived differently by investors. So you see, the reality is maybe the same, but the explanations provided by the theories are different. So one theory is providing a different explanation. It says variable X causes variable Y. And then there is another theory that comes and says, no, variable Z causes variable Y. And then there is another theory which says, oh, variable W, X, and Z causes variable Y. Here we will see the same thing. The price of the option is the same, but we are using different theories. So the first theory we will learn is the binomial option pricing model. Now, before we move forward, because it's a mathematical representation, so again, we will talk about the symbols that we are going to use. We are first outlining the conditions or the assumptions that we will follow when we are valuing the option. So the first one is that we live in a one period, two state outcomes world, because we are first learning the one period model. So in a one period model, if today the stock price is S0, at expiration or in future, what is possible? There are two possibilities. One is that stock price can go up, so it will be, let's suppose, SU, and one is that if the stock price goes down, so it will be ST. That is why we call it binomial. Binomial here means two. So there are two possibilities, like yes or no. For example, yes or no, right or wrong. So there are two possibilities. So in the same way, for a stock, if it is trading in the morning at, let's suppose, 100, and we assume a one period world, what is possible that at the end of the day it is up, let's suppose it is 120, or it is down, let's suppose it is 80. So there are two possibilities. So we are living in a one period world where there is nothing happening, or whatever is happening here, the ultimate effect is at the end of the day we are interested in whether the price will go up or go down. So there are two possibilities. The stock price can go up and the stock price can go down. And therefore, we are interested in knowing the probability of the stock price going up and the probability that the stock price will go down. This is what we mean by one period, two outcome or two state possibility. S0, as usual, will be the current stock price. U is the factor by which the stock price can go up, and it will be equal to 1 plus the return if the stock price goes up. So for example, if we are told that the stock price can go up by 20% and the stock price can go down by 25%, so this will be actually like 1 plus 0.2 and 1 minus 0.25, for example. So this will be, the up factor will be 1.2 and the down factor will be 0.75. Then R is, as we discussed in chapter 3 last week, that it will be the risk-free rate. And then we are talking about something like CU and CD. And you have to recall for this that we said last week that call and the put are derivatives. We discussed that if the stock price goes up, the call price will also go up. And if the stock price goes down, the call price will also go down. That's what we discussed then. If we are saying that we are living in a one period world where we say that the stock price right now is S naught, then to get the call price, what we should be doing is looking at what are the possibilities at expiration or at the end of the one period. So at the end of the day or at the end of the week or at the end of the 3 months or 1 year or 6 months, no matter what you have the duration of this period, this can be 1 day, 1 minute, 1 year. Okay. So at the end of the period, the stock price can go up by a factor U and can go down by a factor D. So if it goes up, it will become SU. And if it goes down, it will become SD. The stock price is the underlying factor that determines the call price. So the call price, if the stock price goes up, will be equal to maximum of 0 or SU minus X, which is the intrinsic value of the call option at expiration, and that will be equal to CU. If the stock price goes down, again, it will be equal to the maximum of 0 or SD minus X. And this is again the intrinsic value or the value of the call at expiration. So the call price that we have here is dependent upon the stock price that we will have if the stock price goes up. And the call price here, CD, will be equal to or determined by the stock price that we have here if it goes down. So the stock price is determining what we have here or what we have here. If it goes up, we will get CU, which is the intrinsic value of the call at expiration. And this call price will be this if the stock price goes down, and that again will be equal to the intrinsic value at expiration of the call. So we have S naught here in at time T, and we have this as the expiration. So the stock price going up by U factor, so it will be equal to SU. And if it goes down, it will be equal to SD. And this will determine the call price. We just learned that it will be CU and CD, which is equal to the maximum of 0 or SU minus X. And then we have CD, which is equal to maximum of 0 or SD minus X. This is the future value of the call if the stock price goes up. And this is the future value of the stock of the call if the stock price goes down. If we know the probability of the stock price going up and the stock price going down, what we can do, we can calculate the value of the future cash flows from the call, and then that is the value of the call option. In other words, as we discussed in week 1, and I told you in finance, we say that the value of anything is equal to the present value of all its future cash flows. That's the rule we follow. Here there are two future cash flows possible from the call. If the call is in the money, the stock price goes up and the call is in the money, the intrinsic value or the cash flow from the exercise of the call will be equal to CU. If the call is out of the money, or if the stock price goes down, it doesn't have to be like the call is out of the money, CD. So what will happen? This will be the cash flow. What is the chance of getting this cash flow? What is the probability of getting CU? So that is equal to the probability of the stock price going up. We have P here. And what is the probability of the stock price going down? If we know that, that is 1 minus P. So, and you know that the probability of going up and going down should equal to 1. That's the rule we follow in probability analysis. So what is the cash flow that the stock price would go down? Because in that case, our payoff will be equal to CD, 1 minus P. So if we know the cash flows that we will receive if the stock price goes up and the cash flows that we receive if the stock price goes down, and we know the probability P and we know the probability of 1 minus P, we can use a formula to get the value of C naught, which in this case will be equal to the value of the call today will be equal to what you will get if the stock price goes up plus what you will get if the stock price goes down multiplied into the probability that the stock price will go up, so that is P, and multiplied into the probability that the stock price would go down, and then because you have to discount it, so you will be discounting it at what rate? The risk-free rate. Remember, we will be discounting all cash flows using the risk-free rate. So this is the calculation of the call price in a one-period world where the stock price can go up by by U factor and by go down by D factor, and the probability of going up of the stock is P, and the probability of the stock price going down is 1 minus P. So now here you see this is represented in figure 4.1. So as I said, there is a possibility that you will receive this cash flow, which is basically the intrinsic value of the call if the stock price goes up. And this is the cash flows that will be received if the stock price goes down, SD. I'm saying goes up or goes down. It's not necessarily the purpose. Okay, so for example, I'll just say S naught here is, let's suppose, 100. And the stock price can go up by 25% or go down by 25%, or let's make it the up factor is equal to 1.25 and the down factor is equal to 0.8. So the stock price can go up to let's suppose this is U, so it is equal to 125. And if the stock price goes down, so then D is equal to 0.8, and it will be, the SD will be equal to it will be equal to 80. Now, it is also possible that S naught is equal to 100, and we have it like this. SU is equal to, let's suppose I just say 1.25, U factor is equal to 1.25, and D factor is equal to 1.1. So the stock price goes up to 125, and the stock price SD is equal to 115. Basically, binomial means two possibilities. Okay, so possibility number 1 and possibility number 2. So here most of the time we will be assuming that the stock price can go up or go down below 100. However, it doesn't actually mean that the stock price cannot be like this. So in both the cases, the stock price is going up. You see, stock price going up by 25% and the stock price going up by 15%. So here SU is 125 and SD. So generally people consider that it will always be below 100 here. It's not necessarily the condition. Okay, so in such a case you will have your CU equal to, for example, equal to 25 here, and your CD equal to 10 here. But here in this case it will be equal to 25 and it will be equal to 0 because it is out of the money. Do we understand this? So as I said, this is the future value if the stock price goes up. So this is the future value of the call if the stock price goes up, and that is equal to the intrinsic value at expiration. And this is the future value of the call, that is the intrinsic value of the call at expiration if the stock price goes down. Okay, so if you want to know the call price here, simply calculate the present value of all the future cash flows. Present value of the future cash flows here is made difficult by one thing, because you can either get this one or this one. These are mutually exclusive. You can't get both of them at the same time. So either you will receive this cash flow if the stock price goes up, or this cash flow if the stock price goes down. So this just necessitates only one thing, that we take into account the probability of the stock price going up and the probability of the stock price going down. If I want to calculate the current call price, I need to know what is the cash flow that I will receive if the stock price goes up. And I need to know what is the cash flow that I will receive if the stock price goes down. That is given already to us, CU and CD, and which is derived as the intrinsic value of the call, okay, if it goes up, and the intrinsic value of the call if the stock price goes down. If we know the probabilities here, we will just multiply each cash flow by their corresponding probabilities, and this as a combination will be called the weighted cash flows. Okay, in other words, the word we use is the expected cash flows, and you know what expected means, because there is a chance of getting this one and there is a chance of getting this one. So if you are multiplying them by their probability, you are taking average cash flows. So this is basically a weighted average of the cash flows. And because this will be in future, so to get the present value of this, you will discount it by the risk-free rate, and if you do this, you get the call price today. The same principle will apply in a two-period world, where we will extend this further, and you will see that we will get cu square and cud and cdu and then cd square, and again we will have the probability of this equal to, for example, p square, and the probability this will be the same, so we will get the probability of this into we will just learn about it, so 2p into 1 minus p, for example, and then cd square will be again having a probability of 1 minus p square.
We use a full binomial function formula for this.
Yeah, we are going to learn about that later, because right now we are just going step by step, one period, two period, because I have to prove to you why we are using the risk-free rate, isn't it? So first we will learn why the risk-free rate is here. Now there is one text box in the chapter number 4 where they are trying to make the connections. I would recommend please read that very, very carefully, and if you have any doubt, discuss that with me. It is self-explanatory, but you will see there is some logic behind these formulas and calculations that we are doing it, and that will further enhance your understanding. So we have to learn this use of risk-free rate as a discounting factor here. Once we know this, then we will move into the model where we actually have the extension into what you can call infinite number of periods for the binomial model, okay, which is the limit to the Black-Scholes, and basically convergence of the binomial distribution to normal distribution. That is what we will learn at the end of the day. Before we start valuing the call, as we said, that there are preconditions that we need to understand. So one of the most important precondition here is this, that is the D factor will always be less than 1 plus the risk-free rate, okay, and which needs to be less than the U factor. If this rule is violated, then what will happen? There will be arbitrage. So for example, the D factor is 0.8. That is, if the stock price goes down, it will be going down by a factor of 0.8. So if it is right now 100, if D is equal to 0.8 and U is equal to 1.25, and the risk-free rate is equal to, let's say, 0.05 or 5%. So what is happening here is that we have 1 plus R now equal to 1.05. In this case, our rule is being kept intact, that is 1 plus R is being greater than D and it is less than U. So you can see 0.8 and then 1.05 and then 1.25. Now why this is important? Let's have a look at this. If the stock price right now is 100 and it can go up by U and it can go down by D, so it will be 125 here and it will be 80 here if it goes down. So that is SU and SD. Now this is all right. This can be the case. What cannot be the case? For example, if we have a situation where 1 plus R is less than 0.8, okay, and less than 1.25, that is 1 plus R is less than D and less than U. So what will happen? Let's suppose if 1 plus R is like in my case, if it is 1.05 and D factor is 1.1 and U factor is 1.25. So like in my previous example, if the stock price can go up to 125 and it can go up to, even if the D factor is taken, it can go up to 110. and right now it is 100, that is S naught, and we have the risk-free rate equal to 5%. 1 plus R is less than D, which is less than U. So here we have an arbitrage opportunity. How? For example, in this case, if I have 100 pounds, what will I do? I will borrow at 5% from the bank and invest in stock at 100. So I will buy the share of this company by 100. The interest rate is 5%. What will happen? In future, the stock price will either go to 110 or 125. If it goes to 110, I will sell it for 100. I'll realize $100 or 100 pounds, and I'll pay back the bank loan. Plus, if there is a 5% interest, even if I deduct that, I will still get 5 pounds. If it is at 125, I'll have the same thing. So I'll have higher gain, 25 minus 5. So I'll have how much gain? 20. What is happening? I am able to borrow at a rate that is less than the rate of return if the stock price goes down. So there is no chance of me losing money in the future. So I am being able to borrow money at 5% and invest that money in the stock, and there is no chance of me losing any money because the stock price will go to either 110 or 125. So if it goes to 110, I am able to pay back the bank loan plus interest and still get 5 pounds. So no chance of losing money here. Again, if the stock price goes to 125, I am able to pay back the bank loan plus the bank interest, and I'm left with 20. So everybody will start doing this, and this will do what? This will increase the interest rates. As a result of that, we should be back to the equilibrium position, which is that D needs to be less than 1 plus R, which needs to be less than U. If this is the case, for example, if D is less than 1 plus D is less than U and U is less than 1 plus R, for example, D is 1.0, let's make it 1, okay, and U is 1.05, and 1 plus R is let's suppose 1.1. So in this case, the opposite will happen. I will do what? Because the stock price today is 100. It can go up to 105, or it can be the same 100. Okay, let's make it. Or even it can be like, if I take this equal to 0.8, it can go to 80. So let's make it 0.8. So it can go to 80. So in this case, what will happen? I will short the stock of the company. If I short the stock of the company, I will get 100 pounds from there. And then what will I do? I will invest that money in the risk-free bond to earn 10%. If the stock price goes to 105, I will buy the share for 105 using the $110 from the bank investment, and still will be left with 5 pounds or $5 as my return. Okay. If the stock price goes to goes to 80, I will be getting 100 plus 10 from the bank where I have put the money from short selling, and use it to buy back the share for 80. In that case, my gain will be 110 minus 80. How much is this? 30. So you see, this is the rule. D should always be less than 1 plus R, which should be less than U. Okay, if this rule is violated in either direction, there will be an arbitrage. So if D is less than U, and which is less than 1 plus R, you will short sell the stock and invest in the risk-free bond and earn this much. In both these cases, there will be no chance of you losing money. This will be an arbitrage. Other pupils will start following the same thing, and this will re-establish the equilibrium. If this is like 1 plus R is less than D, which is less than U, again, in that case, you will borrow at the risk-free rate, and in no case you will lose money in future, and that again is arbitrage, and that will again invite other pupils to do the same transaction.